Welcome. Happy Sunday. I want to make sure my audio is right. It hasn't been right these past couple of live streams, and it looks right. How's the audio on your end? Can I get a sound check? Is that okay? I listened to it again on Twitter, our Thursday night stock charts live, and the audio was just really, really bad. It was like I was using the webcam microphone. Okay. Happy Sunday. Larry, thank you very much. Appreciate it. Franklin, welcome. Jeff, thanks. Jeff, appreciate the sound check. Okay, it's Sunday. A little bit of housekeeping. I will be flying to Paris on Thursday night. So no Thursday night stock charts live this week. In fact, it's going to be a couple of weeks where we don't have live streams on Thursday nights and Sunday nights. Just time to veg out a little bit. I'm going to be over in Paris and then in Italy for the majority of the time. But I will be in contact with members, and we will be trading, of course, because I'm an addict. Yeah, that's the game plan. So if you're wondering why there are no live streams, I'll be in Europe, and maybe one night I will pick it up and just do an ad hoc session because I'm bored out of my mind. But right now, I'm just prepping everybody for the worst and hoping for the best. All right, so we're going to talk about the opening futures action. They are open. I've got them in my peripheral vision here. We're going to talk about the Berkshire Hathaway summit this past weekend on Saturday. We'll go over a couple of headlines out of it, and we'll talk about some headlines that we want to talk about. We want to really focus. I'm not a big believer per se in valuations until you're supposed to believe in valuations. When you get a stock market going like this, growth stocks are, all the rage. You don't really care about PE ratios. They don't matter. But when you have earnings and sales going like this, yet your PE ratios are still like this, I think it's time to start looking at valuations. So let's talk a little bit about valuations. We'll talk about the Qs, how they closed out the week, our bias, whether we are bullish or bearish for the new trading week. We'll talk about the advanced decline line. We'll talk about yield curve. So let's get to it. Let's go to comments. Let's say hello to people. Again, Larry and Franklin, thank you, sirs. Welcome. Seymour Rivers, thank you, sir. Welcome. Mr. Jeff, thank you. RB, welcome. Good evening, Pete. Mr. Pete. Thank you very much. Thank you. Really looking forward to it. Hi, Bob Wall and MCRB. Please, I'll try to write them down as I go along here so I don't forget, because I do forget, and then I have to scroll back up through the notes, and they get to be a little bit too much. Let me be proactive. Blue Zayton, welcome. Buster Stacks, been a while. Welcome, brother. TF Hatter, hi Bob, and the chat, welcome. IEP, AMZN, okay. QNST. What dollar value is QNST? Out of curiosity. Coco. Okay. Franklin. 6 hours difference between New York and Paris. Yeah, I'll probably doing. I was thinking about when I would be doing the videos. I'm an early riser, so I'll probably doing. Rather than doing like a market wrap, I'll probably do like a morning update about the previous day, because I'm going to be spending about. I rented out a little farmhouse in the Tuscany region on a vineyard, and it's got an olive oil plantation, olive oil farm, whatever you call it, and they have a nice pool there. So I figure, you know what, it's a great place to set up if I can get the Wi-Fi to do it, and do a video from there early in the morning before everybody gets up. That's the game plan. We'll see how that works out. I don't know how much jet lag is going to play into it, but we'll work through it. QNST 810. Oh, okay. Wow. Interesting. So you have an RSI below 10 on an $810 stock. Wow. Okay. So RSI, very interesting. Okay. To me, that sounds like a stock. We'll check out the premiums on the options, the IV ranking. Maybe you want to sell puts and just keep a little bit of a buffer on for risk. So we'll go over that in a moment. So let's get to it. Let's go to the futures action here. We have the E-minis. I'm going to share my screen. That would help, right? Okay. So we have the E-minis that are open. And we're flat for the most part, biased to the upside, spot 4% here. We have resistance immediately above. You can see that we broke out above it late in the afternoon on Friday, faded down below it. Let's see whether or not we could put in a new higher high. We're not that far above. Moving on to, we'll stick with equities, mid caps. Nice breakout here. Mid caps up spot 1.3%. A little bit of strength here of outperformance in the mid caps relative to the large caps, and no great shock. Let's go from the mid caps to the Russell. Opening candlestick 15-minute chart outside reversal bar or a bullish engulfing. Folks, if you're new to technical analysis, you don't know what that is, I have a 5-part video tutorial free down below about my top 5 favorite candlestick patterns. Take advantage of it. Outside reversal bar, very bullish setup here at the open. Looks like the week is starting off strong for in particular, the mid caps and small caps, to a lesser extent, the larger caps. Let's check in with the NASDAQ 100. This is basically your futures version of the triple Qs, and they're up fractionally. So again, going back to, we're seeing outperformance in the small caps and especially the mid cap arena relative to the large caps in the opening session here. We'll see whether or not that carries through to tomorrow, but my hunch is it probably will. Because what happens frequently when you get to the cycle in the market where you have the large caps, which have had a decent run, they're expensive, and then you so-called your overly shorted, your heavily shorted names, your junk stocks. Not that these are all junk stocks in the S&P, excuse me, in the mid caps and the Russell 2000, but they're lesser quality. By and large, they're lesser quality. They begin to outperform. Shorts get squeezed out of those names, and that gives you the perception that the market's still got legs. So that's just the way it is, and we have to recognize it and appreciate that's the way the market works. We could be as bearish as we want on the overall market, but it appears as though the path of least resistance going into the new trading week, according to the futures action, is to the upside. Moving on to commodities, when we talk about commodities, we must know what the U.S. dollar is doing first. And the U.S. dollar is technically up on the session. We closed lower. What was the close here? Close was at 101.21. Last tick on the dollar was 101.27. So a little bit of strength here on the dollar. The one thing that needs to be appreciated, and I went over this with members yesterday on the week ahead commentary strategy session, was that the dollar broke support last week. So if the dollar doesn't gap up this week, pretty much by noon tomorrow morning, regular hours session, not even noon, by 10 o'clock, 10:30. The dollar needs to be above that breakout point. If it doesn't, if it flirts with the breakout point, it's probably going to weaken throughout the week. So I'm not loving the US dollar here. It is at currently up. Perhaps it'll gap up in the regular hour session, and we will see some additional weakness in the commodity space. Now, the euro, which closed out the week pretty strong, consolidating here. This is the second largest, excuse me, it is the largest component in the Dixie basket relative to the US dollar, as goes the euro. In general, inversely goes the US dollar. At current, we have the euro, not so surprisingly, down on the session. We're off session lows, giving us the green candlestick, but it looks like we're giving up a little bit of real estate here. Let's check in with the yen, which reversed off the lows of the week last week to close up, but your stochastics are still weak, week over week, pardon the pun intended. And we have a week open here again with a week, 3 times, 2 sentences. Pretty good performance here. We have a head and shoulders setup on a 15-minute time frame. Here's your left shoulder, here's your head, right shoulder, here's your neckline right down here. So yen under pressure. If the euro does not rally, if you see a pullback on euro, pullback on yen, that sends the dollar up higher. So with that being a known, let's take a look at how gold prices are reacting to the currency fluctuations here. First let's check in with Bitcoin. Bitcoin's been going back. Yeah, I kind of figured this was going to happen. So Bitcoin breaking trend here pretty significantly. Let's go to a 4-hour chart. This is a major break on Bitcoin. We were flirting with a breakout yet again. That resistance level, yeah, this is a failure. If we close right now, it's not a failure, right? We've gapped down into a prior trading range. We had broken out on Friday at current. Let's call it a retest of the breakout point. Okay, we don't want to be doing gloom here, but if we close down below, let's call it 2,900, 2,920 on Bitcoin. We're probably going lower. So Bitcoin under pressure here in the opening minutes of trade. Here's a 15-minute view. Pretty big break here on Bitcoin. Moving on to gold /GC spot price. And at the open, we have gold down fractionally, $2 the ounce. Now, on Friday, I mentioned on Thursday night that I had lightened up on, we still own our gold position. We had lightened up on silver. We had lightened up a bit on the gold mining stocks due to my concern about a deflationary trend coming into the market. Why would that be? Well, you have the banking crisis that's since been resolved. The second banking crisis of the year has been resolved within a week. Don't worry about it. Don't look here. You're all good. Go back to work, invest your dollars, and spend like an animal. Well, people are spending like an animal. They're charging up their credit cards and they're using them for groceries. Okay. This is not going to end well. And what's going to happen is a tightening of lending standards. And when you get that tightening of credit, that's when you get a deflationary spiral that comes into the market, causing prices to go down. Why? It's because companies can't expand to produce. If they're not producing, people can't buy. And when you have a tightening of credit standards, people pay down their credit cards. They're not spending on those credit cards. Why? Because they've already maxed them out, or the banks have come in and says, you know what, given the current market conditions, we are going to cut your credit limit. And by proxy, even though they didn't blow out their credit limits, they have now seen their credit limits cut by the banks, and all of a sudden they're underwater on their debt. Right? They don't have any more money to pay out. Their credit scores go down. Why? Because they're maxed out on their credit. So it's a very, very bad thing to happen. And I think that you're beginning to see a little bit of pressure on gold. There's a lot of talk out there about a triple top on a monthly time frame. I don't know about that per se. I'm not a big believer in triple tops. I'm a big believer in strong resistance, and every charge at that resistance level has a higher probability of breaking through. So while we may see a pullback here on gold short term, I don't think it's going to be long lived. So the dollar, if it does weaken up, that is going to send gold prices higher. And a lot of people are out there saying if yields move up higher, that means that gold can't move up higher. That is not the truth. Go back to a chart of the 1970s price of gold relative to the 10-year yield, and they both went up during the 1970s. The key was what didn't go up was the dollar. It was going down. What's gold priced in? The US dollar. So at current, gold down fractionally at the open. Let's check in with silver. Silver down fractionally. No big moves here whatsoever. Let's check in with oil, which was annihilated last week. It made a rally back on Friday by about 4%, but net on the week, a very bearish week for crude. And here's light sweet crude. We're rallying at the open here, up about 0.75%. The energy sector broke monthly support last week. Let's check in with nat gas. Before we go to nat gas, let's check in with home heating oil. Moving up over 0.75%. Now we go to nat gas. Nat gas gapping up about 0.75%. Let's check in with the 4-hour view here. Nat gas is still looking pretty weak on a 4-hour time frame. We have broken out of this downtrend channel, but it's so volatile. So nat gas is so hard to play. We've had mixed results with nat gas. Can't say that properly. All right, let's check in with protein now, folks. We talk about commodities every Sunday night, and I even go into granular detail about cattle prices, hog prices, and why we do that. It's not that I trade them; it's that I want to get a pulse for inflation, and that's why we take a look at energy prices. We don't want to wait for next month's CPI. Actually, comes out this week. For last month CPI data, we want to know real time what's inflation doing, and that's why we do this. So when you take a look at cattle prices, I'm going to go to a weekly chart here because we don't watch them all week long. I did check in midweek last week, and things had changed quite a bit on cattle because we were very, very look at this weekly chart of home heating oil. Oh, nat gas. Nat gas is a breakout weekly time frame. Okay, what's the IV rank for Boyle. Maybe we'll sell some premium in here. Not very good. Better off buying the call options. Let's go back to our charts. Let's go back to cattle. I digressed. All right, so for cattle has been in a huge uptrend. Now I'm a big New York strip eater. Love it to death, and waiting for those prices to come down. And you'll note that we had broken trend, or I shouldn't say broken trend. We had broken support back here in March, and we saw an orderly pullback. Then we saw a resumption of the move up higher. Then we had this big outside reversal bar the week of April the 3rd. And we pulled back again. This support level here, which continues to rise, held once, held twice. Then this time last week, we went over this chart and we had a bullish reversal bar. Very, very bullish stuff. For all intents and purposes, we should have had a continuation rally, which we did, except it couldn't hold. There were not enough bulls out there. Pardon the pun. We're going over cattle. I know there's a pun there. The pun was intended, but it broke support last week. This support level is now in the rearview mirror. So I think that what we're seeing in protein finally is a break of support. Now, we have hogs up here as well, or at least I had hogs up here. I did have them up here. They limit the amount of symbols that you can have up on your recent tab, and then you'll lose them if you exceed the amount. Here we go. Lean hogs. Now you can see that lean hogs had broken support back here in August of last year, and they've been in a bit of a correction / bear market. And it looks as though, given last week's price action, we're going to see a resumption of the downtrend here on hogs. So it looks as though protein prices are coming in a bit. So that's a really good thing. Now, when we go over and we take a look at agriculture, we'll begin with corn. Look at the breakdown on corn. Last week, no follow through the downside, but a very significant correction here on corn. When you take a look at, we were up at 8.24 the bushel. Now we're down to 5.97 on closing last week. So a pretty significant break here on corn prices. Taking a look at soybean prices, and many people don't appreciate how much soybeans are a part of our diet. And we peaked out back here, 17.83 the bushel back in June of last year. Now we're down to 14.37 last tick. So I think that we have a head and shoulders set up here. Let's clear all this off. And we could just do, I don't know, this. Here's your neckline. And we broke the neckline last week. So it looks like soybean prices are going to see a continuation breakdown in the coming weeks. We broke down the week of April the 24th. Last week, we did a retest. Maybe we'll rally, maybe we'll recapture support. But generally what happens is that this retest gets rejected because there's not enough buyers out there, and we break to new lower lows. Now, lastly, we'll take a look at wheat prices. Now, wheat has really gone into a big, big bear market, losing more than half of its value since the peak back here in March of last year. So think about this correction. We were up at 14.10 the bushel. Last tick, 659 spot 875. So a major, major correction here. Total bear market on wheat prices. So good thing for the consumer, but this goes back to what I was saying earlier, is that it appears as though wheat prices or agriculture prices, commodity prices, we can take a look at a basket of commodity prices to get a really clear picture of the direction of commodities. This is the Bloomberg Commodity Index. You hear it referenced quite a bit on the news. And we had peaked out back here at 138.2. Last tick was 103. So clearly the trend is down. We've stabilized, but the path of least resistance remains to the downside until we break out. So that's where we're at. So as bullish as I want to be on gold prices, we did lighten up in anticipation, not in gold, of silver. And when I say gold, I'm speaking of gold, gold miners, and silver, all in one bucket. So we lightened up on that trade a bit, but we will be adding back, ideally at lower prices. We'll see if we're right on that. Maybe, maybe not. Okay. So did I go over everything I wanted to? I believe I did. Let's go to comments. Trader Isaac, welcome. TC Bird, audio is good. Thank you, sir. Franklin, you got it, brother. Paul, thank you very much. Welcome. And TF Hatter, yes, please smash the like button if you would. It helps me out with that YouTube algorithm. I get these kids with Lamborghinis trading the stock market. They never lose. They never ever ever lose, and they get 30,000 views. So please smash subscribe. It drives me crazy. How about CrowdStrike and OKTA? And OKTA, KTA. Okay, you got it. All right, let's take a look at the week ahead. So last week we closed out the week with the Qs doing a reversal. I was disciplined. We did not go adding to shorts on the week as much as I wanted to, as much as I believed that we should have. Even on Apple's earnings, I wanted to short the market. I was reluctant to. In fact, we closed out some shorts early on in the week because I feared exactly what would happen. It did happen. Excuse me. I feared what might happen would happen, and it did happen. And that was a reversal to close positive on the week after seeing a breakout the week prior to last. So, a long story short, the path of least resistance on the triple Qs appears to be to the upside. In terms of advances versus decliners, I had mentioned this last Thursday that this is a concern. By the end of the week, we did see the advancers begin to pick up. So you saw a broadening out of breadth on the week, which is a good thing. More participants. The one concern I do have about a 2% up day as we had on Friday is that volume was not good. All right, so they had better get a follow-through day here on rising volume, toot sweet, because you can't have rallies on 2% on below average volume and expect institutional buyers to come in at the back end of that rally and help support the market. No, that's when retail buyers enter the market, not institutional investors. So a warning flag on the track here. And the one thing I do want to talk about and send out a warning on is that we have the yield curve, which on Thursday night, if you remember and you were here, we had put in new monthly higher highs. On Friday, we did back off a bit, but net on the week, we saw a hookup. We have a double bottom setup and a higher low on the yield curve. Why does that matter? Don't worry about equities when the yield curve is in a free fall. Worry about the steepening. Worry about the steepening because that's when bad things happen in the equity market. And we saw that new higher high. And you could see the correlation to the S&P 500 is not good. It's pretty much flat to inverse of the S&P 500. So as goes the yield curve, inversely goes the S&P 500. Watch this chart. It's building momentum and not a good thing for equities. Coming out this week, not much coming out tomorrow. Wholesale inventories are important. Nothing on Tuesday. Wednesday, we get CPI. That's for April, but we already went over real time what the charts look like for the May data coming out in June. We don't want to wait to June. We want to be ahead of the curve by knowing what inflation is doing right now. To me, this is insignificant because in all probability, this is going to come out a little bit hotter on the month. Why? Energy prices this time last month were firming up. Now they've broken down. So this report it's old data for me. So if it does come in hot, I don't think you're going to get much of a rally in yields as you might expect. And why would yields rally? It's in anticipation of the Federal Reserve having to raise interest rates. I think that this is really a nothing report that's coming out. I think it's already negated before it even gets reported. On Thursday, you're going to get PPI. That's the producer price index. That's the cost of inflation at the producer level. Initial jobless claims, we get that every Thursday. And on Friday, we get import price index, not really important. And we have a couple of Fed heads coming out this week. So in terms of economic data, I think that the economic data is going to allow for the equity markets to move up higher because there's not much news out there. Unless, of course, we have another bank that goes belly up, some risk that comes across the headlines that we don't know about yet. But right now, it looks as though it's all clear for the equity markets to proceed up higher for at least another week because the charts are saying it. We have no headline risk that I could see anyway. Earnings, for the most part, are done. Speaking of earnings, you're going to get after the close on Monday, Friday. On Monday, we're going to get PayPal. Then on Tuesday, Airbnb, Twilio. I'm looking at the ones I trade on earnings, and not much coming out this week. Quiet week. These are all your low quality stocks, these small cap names. Not all, many of them. Yeti is a great high quality name. Yeti, love my Yeti. And that's about it. So in terms of earnings data, until you get Nvidia coming out soon, I believe they come out on, I believe it's the 26th, around there. I think that earnings are going to be there's nothing there. And I think that you really close it out with FedEx and Cisco Systems. So by and large, earnings season for the most part over. So in terms of quality of the market, we started talking about the valuation of the market. And when you're in a bull market, you're not really concerned about valuations. There's a lot of hot money out there. The Federal Reserve is in the process of cutting rates. So money's just rushing into equity markets, growth stocks. Nobody cares about valuations. Companies aren't even making money, and they're seeing money inflows. But we're not in that environment anymore. We are in a walking on eggshell environment, and this is a great tweet out of Michael Kramer. S&P earnings season is almost over. Currently, sales growth of 4%, while earnings have dropped 2.72%. Now, think about what the media tells you when these companies report earnings. They beat expectations. I don't care. I don't care, and neither should you. What I care about is, did they beat year over year? Did they beat quarter over quarter their results from the prior? Everything else is noise. We don't care about whether or not they beat reduced guidance because they manipulate the EPS anyway. All I care about really is their sales growth. Did they see sales growth? And by and large, sales were not great. Earnings were not great. And here is a look at the forward PE ratio of the S&P 500. And you could see down here, forward-looking PE, that is the line chart, the 5-year average in green line, and the 10-year forward-looking average in blue. So in this market environment right now, yes, we're below the 5-year moving average. However, we're still above the 10-year on a forward-looking basis. So are equities cheap? No, not by any stretch of the imagination. And when you take a look at Apple's earnings, they were so great. They ripped Apple through the ceiling, and they took the Qs along with them. What they didn't bother really announcing during the release of their earnings, which they to be fair to Apple, they don't give forward-looking guidance on their headline that comes out reporting their earnings. They didn't tell you that the forward-looking guidance was reduced. So they rallied Apple on Friday, even though their forward-looking guidance is going to come in lower. And Apple's valuation, this has it at 30. We want to be really accurate. This is not completely accurate. I want to be 100% accurate when we report out. It's close, but not exactly. A PE ratio of 29. So we need to put things into context. What is the average PE ratio, trailing PE ratio for Apple? It's about 24, 25. So they rallied Apple on Friday to a 29 PE, even though their forward-looking guidance was brought down. Tell me that's sustainable. And when you take a look at the overall equity market, Shiller PE ratio, we're at a 29 handle. We're still flirting with a 30 handle on the S&P 500 as a whole. And going back to Michael Kramer's tweet, sales growth of just 4% while earnings have dropped 2.72%. Inflation adjusted, that is simply not good. So while inflation may be coming in a little bit, it's not gone. Which brings us to Warren Buffett. So they had the Berkshire conference, which they have every year on Saturday. And the headline here, Buffett turns gloomy. The incredible period for the U.S. economy is coming to an end. So I highlighted this. We could just blow through it really quickly. On Saturday, the head of Berkshire Hathaway had a far more downbeat and gloomy prediction for his own business. Not only was he dire about the economy, he was dire about his own business and the broader economy in general. The good times may be over. He expects earnings at the majority of the conglomerate's operations, that's Berkshire conglomerate, to fall this year. And think about this, high quality names that he has, high quality names, but highly cyclical. As the coming economic downturn slows corporate activity further, the majority of our businesses will report lower earnings this year than last. He's looking at it accurately. He's looking at his business relative to the prior year, not according to analyst adjusted expectations. During the last 6 months or so, the incredible period for the U.S. economy has come to an end, he said. Buffett himself has said that Berkshire owes its success to the incredible growth of the U.S. economy over the decades, but his prediction for a slowdown at his firm comes as upheaval at regional banks threatens to curtail lending. And this is what I was talking about earlier. The next step in this banking matter that's going to impact the U.S. economy. Let's say that the banking crisis is over. Okay, fine. The charts aren't saying that, but okay, let's say it's fine. The second banking crisis of the year is all over. It's safe to go back in the water. Okay, now we're going to have tightening of credit standards. And he's seeing it. Banks threaten to curtail lending as inflation and higher rates continue to bite. And according to Charlie Munger, 99 years old, the guy's as sharp as a tack. Get used to making less. That's great news. With after-tax earnings, Berkshire Hathaway Energy falling 46.3% from the same time last year, amid earnings from U.S. regulated utilities, other energy businesses, and real estate brokerage businesses. Railroad results were also weaker than expected due to a fall in freight volumes and higher operating expenses, according to Edward Jones. So, you can look at Berkshire Hathaway as a proxy for like an index of how the U.S. economy is doing. For that business to do really well and outperform, you need strong economic growth. It'll do okay in an economy that's just getting by because they're slow, stodgy, boring businesses that everybody needs. So they'll still churn out dividends and they'll do okay, but you're not going to get that outperformance relative to the rest of individual stocks. I won't say the market. It may be on par with the rest of the market, maybe slightly above, slightly below, but certainly it's going to be a stock picker's market out there. And Berkshire Hathaway is not going to be one of those stocks that outperforms by a wide margin anyway. And you take a look at the businesses that he's in, you could see that these businesses, this is the railroad index, that peaked out back in March of 2022 with a significant pullback to where we're at current. Utilities, they also peaked out back in, well, actually April of 2022. They haven't broken support here. Excuse me, I don't know if I said utilities. These are utilities. My apologies if I said something else. While we pulled off the highs of the year, they haven't broken trend. What would send the utilities lower is if yields move up higher. So if we get a hot CPI number this week, a hot PPI number this week, that could send yields up higher at least briefly anyway, and that could impact the utilities. Why? Because utilities are capital intensive. They need to go out and sell bonds to help finance expansion of their facilities or maintenance of their facilities. So they need to compete with treasuries because they're perceived as being a higher risk investment than what are treasuries. So they need to pay a higher interest rate. So if CPI goes up, that means bond yields goes up. That means the yields they pay on their bonds, they need to go up higher than treasuries. So keep an eye on the utilities right now. I don't see a lot of bad things here, to be honest with you. Now, the banks are a different story. Now, Warren Buffett's invested in a lot of big money center banks. I don't know how much in terms of regional banks. We'll take a look at the regional banks in a moment and how they closed out on the week last week, but on a monthly time frame, clearly the money center banks or the big banks, according to the XLF, not something that you want to be invested in right now. They're not looking great. I'm not seeing a setup here. Maybe it'll change by the end of the month. But if you want to take a look at this on a weekly time frame, that's a wrong chart. Oh, we're speaking of deflation earlier. I'm glad I actually made this mistake. Gasoline broke support last week. It broke support. So that's a good thing. Back to the weekly chart of the banks. I think that these break lower. I think that what you have here on the banks it's already happened. We've broken an uptrend. This is a dead cat bounce, a bear market rally, and we've already broken support. So I don't know what keeps the banks up here right now. I don't get it, but looks as though they want to take the large caps up next week. And who am I to argue? When we start seeing people, if you're out there saying, when are you going to start thinking about shorting the market aggressively? I do have a small short position on it, but not as big as it was. When we start going into trading days or in particular trading weeks where we begin a week off, like right now you have the futures that are up solidly. Let's say they carry through to tomorrow morning. We have a strong update tomorrow on volume that's a little bit, it's not horrible, but it's not above average. And you get Tuesday, same deal, more upward move, volume drifts off a little bit. And then by Friday, you have a reversal and we close lower on the week, or we open up strong tomorrow and we get a couple of days where you get a strong opening, yet a reversal to close lower on a day. That's the market saying that you have money managers out there. What they're doing is they're selling strength. They're churning. They're taking advantage of any rally to get out. That's a very bearish event. You don't want to get heavily short the market until you start breaking weekly trend. We're not there yet. Right now, we're still in an uptrend. So a lot of work needs to be done for us to say, okay, now it's really time for us to get net short this market. We're just not there yet. And I'm worried about on the banks, these stochastics rolling over. They give that appearance right now. If we make a new weekly lower low, that's surefire. They're going to make a new lower low. They're going to roll over here. So watch the banks. Big down volume last week. And when you take a look at the KRE on the week, this is not a screaming buy by any stretch of the imagination. Think about it. On the year, we'll come back to this chart in a moment. On the year, the regional banks are down 34%. And here's the weekly chart. Stokes are hooking up higher. That's okay, I guess, but they could stay oversold. Devastation last week. Devastation. So I don't think this is a buy here. I would entertain selling puts, maybe sell a put spread, but I wouldn't be a buyer of these names quite yet. I think that there could be more downside. And if there's more downside here, I worry about that spillover effect into the rest of the equity market. And looking at their deposits, to be fair, and I don't want to be doom and gloom here. I should have had this at the ready, to be honest with you, but the drawdowns of credit lines from the Federal Reserve, from the regional banks, have reduced. So there doesn't appear to be much pressure on the Federal Reserve by the regional banks to provide liquidity as there was a couple of weeks ago. That being said, the number of deposits that are leaving these banks is dramatic. So not good, because they're only getting paid. they're only getting paid less than a percentage point on these deposits when you can get paid, what, 5-6% on a 3-month treasury bill. It's crazy. So you're losing money by keeping your money in these banks because you have to pay taxes on the interest that you earned. Then you have inflation rallying at 5-6%, completely gobbling up any of the interest that you're earning. So why would you ever keep your money in these banks? It doesn't make any sense whatsoever. And when you take a look at where we're at, the Fed funds rate, this is something that you always got to watch. And almost always, it ends with an event. I would argue that the event has already begun. And that event is FTX. And then you have the banks that starting going down. And it's slowly drip, drip, drip. It's reminiscent of 2008 going into 2009 when you had early on Bear Stearns went down after a couple of other smaller banks went down. And then over the course of the year, every few months, we went over this about 2 or 3 weeks ago. I went over the timeline of the financial crisis, and it takes a while. But after a while, you get enough of these events that occur where the markets say no mas. And here we are. We're above where we were when the subprime on the Fed funds rate, when the subprime crisis hit. So be careful. Be really, really careful in this market. But that being said, when we go by the charts, it appears as though the path of least resistance remains up until it doesn't. When we see the market signals saying reversal days, reversal weeks to the downside, okay, we watch the volume. We're seeing big selling out of institutions. Then we pay more attention. Then we rebalance and we say, okay, should we be getting short here? And that's what we'll be looking for. RB, great point. I forgot to mention that. Yeah, we're going to have a debate continue about the debt ceiling going into this new trading week. Normally, I would say that it's going to happen. They're going to do a debt ceiling, but you have a lot of incompetent people in Washington. We historically have incompetence in Washington, but now you have like I don't know how to say things more poorly about these people than just that they're utterly incompetent relative to their predecessors. I have zero expectation that they'll manage anything properly. So I would cross your fingers. This debt ceiling could turn into be a debacle. It shouldn't, but they may just allow it to. Thanks, Franklin. NVIDIA earnings on the 27th. Thank you for that. I think I said the 26th earlier. Don't sleep on Celsius Tuesday. I don't know what that means. You're above my head. Talon, welcome, brother. XLK. Okay, we could do that. That's the technology ETF that broke out last week. Welcome, Jody. Can we get a free NG? Can we get free natural gas and wheat for free? Natural gas feels that way. Wheat, I'm not so sure about on wheat. Not so sure about. It's stopped going down. I don't see a setup for a buy yet, unlike what I'm seeing on natural gas. So I think natural gas is probably the better trade here to the long side. So let's do some chart requests. And we have first up, let's get XLK out of the way. Folks, we're going to be using TrendSpider, automated technical analysis, incorporate AI into your trading decisions. And we'll do a demonstration along the way here. 35% discount code below. Take advantage of it. TrendSpider. Yeah. All right. So again, for the most part, XLK trades along with the triple Qs, right? So they're very tightly correlated. Qs broke out last week. Actually, they broke out the week prior to last. Retest of support last week. and they're ready for a continuation move up higher. XLK, same deal here. They broke out the week prior to last week, a retest of the breakout point. Volume rose here. So that's a very bullish thing in my eyes. The week prior to last, that breakout on light volume, not that impressive. The retest last week and then the fact that they closed higher is pretty bullish. So I think XLK moves up higher. Now, again, automated technical analysis. What do I mean by that? Click of a button. I didn't put these lines up here except for the one I just drew. This is the algorithm. Click, and you can see that on Friday, we closed right at resistance on a daily time frame. We were stopped here back on May the 1st. So just be aware of that. We have resistance immediately above. So if I want to be a buyer of the XLK, which I may want to be, I'll only want to buy it on a breakout or a pullback. XLK, we'll set the alert up. Long entry on close. What does that mean? It means that I don't want to be a buyer if this alert fires off at 9 a.m. Market is not even open. At 10:30, 11:30, 12:30, 1:30, 2:30. I care about 3:30, 3 o'clock. I don't always go by that rule. A couple of members here will tell you that, and I always regret it. And when I do buy before 3 o'clock and I'm wrong the next day, I call myself Bob the bag holder. That they will attest to. I beat myself up pretty badly. Last time I did it was with the tips, which we're back up on now, but I bought too prematurely. So our alert is set. It looks as though we're going to break out. What I didn't go over here was seasonality. And let's go over that really quickly for the markets in general. We'll go with XLK since we already have it up. Now, for the month of May, it's up 60% of the time. Let's check out the week that we're going into. The next couple of weeks are not good seasonally. Up only 42% of the times this coming week and only 37% of the times the week after. So just be careful here. There's a lot of data. This is 19 years worth of data, so not insignificant. Let's check out seasonality on the trip cues. It's probably going to be similar to the XLK. It's worse. 19 years worth of data, up only 37% of the time going into this new trading week, and the following week 32%, but obviously you could see the spikes up. So if we do get a sell-off, if you're going to trade off of seasonality, if you're going to use that as a factor, if we pull back to a nice support level this coming week and or next, then you could buy at that support level, use a tight stop because seasonality turns back into your favor for the 2 weeks thereafter. Let's check out the SPY. SPY, 19 years worth of data. Again, not good seasonality going to these next 2 trading weeks. In fact, these are the worst 2 sequential weeks, second worst of the year for the S&P 500, up only 37% of the time for the next 2 weeks. So odds favor bears when looking at the chart through the lens of seasonality, but looking at it through the lens of price action as of this point in time right now, I have to give the odds favoring bulls, but that's of Sunday night before the headlines come out. As was accurately pointed out earlier, we have this debt ceiling that's going on and a bunch of knuckleheads in Washington, D.C. trying to hammer things out. Mr. Pat, happy Sunday, pal. Good to hear from you. Okay. They have earnings. It's his company. Gotcha. Now I understand. Tesla, we're going to go over American Airlines too. All right, we can do that. Welcome, Pat. Good to see you, pal. All right, we'll go over CELH as well. But just keep in mind, as Blue Zayton reports, they are going to be announcing earnings on Tuesday. So I am not an advocate of buying a stock into earnings ever. All right, so we went over XLK, AAL. American Airlines looking really good here. Looking really good. This is a monthly chart. Wow, we have a really good chart here. So AAL broke out above resistance back in January of this year and has since retraced several times, but it's been respecting, except for last month, it's been respecting this prior resistance level and acting as support. Now we have opened up above this support level on the month, and it appears as though AAL wants to move up higher. This is a significant macro breakout on AAL. I'm really attracted to this. I'm not a big lover of the airline stocks, but when I see a setup this good, it's hard to ignore. So AAL looking very good on a monthly time frame. Keep in mind, you're going to have resistance up at around $15 per share. Weekly view. There must be something wrong with TrendSpider tonight because it's not giving me the monthly overlays. Okay, we'll have to do without it this week. Something's wrong with the software tonight. All right, so weekly chart. This is significant. Look at the breakout here. We broke down the week of April the 10th, consolidated sideways, closed back above it. AAL is a buy. This is a buy. Daily chart. Daily chart looks good. The only caveat that I have here is that you have resistance up at around 14.12 per share. So you can see that this is probably, as it has in the past, like back here, here, acted as the rising upper band of resistance. So I wouldn't go buying into it. If you get a pullback, you buy that pullback on the day, but I wouldn't go buying into that resistance level. And folks, if you don't have these automated trend lines, take advantage. 35% discount code below, and they give a 7-day free trial offer. So AEL looking really good. Nice chart, Pat. CELH. This company's reporting earnings. I'm loving the daily chart here, looking outstanding. Some positioning in advance of earnings. I'm loving the monthly chart. I mean, really, really nice. I think the way to play this, if you're going to do an earnings trade on it and you're bullish, is do we have what kind of IV rank do we have here? Junk. You know, you would expect if you're an option seller, which is our predominant business, is that we sell premium, we sell options. You expect to be getting paid for the risk that you're taking on into earnings, and they are not paying up whatsoever. So I would not do an earnings trade here. Too much risk, not enough reward. I would wait for earnings to get in the rearview mirror. Even if they spike it up higher, you're going to get a revision or a reversion to the mean. So, you know, don't feel compelled to go buying in front of earnings. And the one thing I don't like here, I mean, I'm loving the rising uptrend channel. Now, obviously, I can't use this candlestick here because it's early on in the month because this is a monthly chart. But you take a look at your volume bars, they're declining. Last month was very weak up volume. That may change by the end of this month, but right now we have fairly light volume. We'll take a look at the weekly chart and the volume week over week in a moment. So we have a breakout on the month. The month is not over. We don't know whether or not it's going to hold this breakout and whether or not it's going to look this pretty by the end of the month. Right now, it's looking good. By the end of the month, it could be a completely different picture. It could be worse, could be better, or unchanged. Weekly view, nice breakout last week. What I think has to happen here is for me to get excited about this chart, earnings, have to be in the rearview mirror. I don't want that headline risk. I would be looking for a weekly retest of support. And technicians out there, believe me, they're looking for this. They're OCD, obsessive compulsive, and they want to see the retest. They want to know what was resistance is now support. So our alert is set. We're good to go. Now we set it and forget it. I'm not going to think about it until after earnings or until our alert is fired off. Daily view. Daily chart looks great. I mean, we broke out on Friday. Again, I think you could set an alert down at 101.28. You know, you get into that ballpark, give or take a dime. I think you could add or open a position, but I would just not do it in front of earnings. I don't do that. So everybody else has their own game plan, but I don't do that. Too much risk, way too much risk. Okay, TA. From a macro perspective, meaning from a weekly perspective, things are brightening up here. We went through a period of weakness, and last week we broke out above weekly resistance. I don't know if they reported earnings not, but check that out before you get involved with this stock. So the weekly chart, we have a breakout. You have a bunch of moving averages above. Those are going to act as natural resistance levels. Daily chart. Now, I wouldn't buy here. The reason is that we closed right at a series of moving averages. I think that this is the 21 period. This is the 20 period. And then above you have the volume weighted moving average. So, and we also closed right at resistance. How do I know? Click of a button. Automated trend lines. So I wouldn't buy it. I'd buy the pullback, perhaps down to this moving average, the 9-period moving average. Create an alert down there. It's a natural support level. Set it and forget it. If it doesn't hit it, you avoid it. Or unless it closes above this resistance level at around 74.18. If we break through, it's still interesting. I know I spelled breakout wrong. Okay. Moving on. WAL, Western Alliance, regional bank. I've only heard good things about this bank. I think there were rumors that were floated out. I think the company came out and said no to the rumors that were out there. They were seeking strategic alternatives. I believe somebody want to fact check me on that. I'd be more than happy to highlight it. We only want to be accurate here. So on a weekly time frame, despite the fact that they're trying to dispel rumors, the chart is butt ugly. I wouldn't short it. I wouldn't buy it either. I mean, it's broken support. It looks as though the path of least resistance is to the downside. Volume is pretty strong. It was pretty strong last week. Daily view. Bounce back on Friday. The question is, does it have legs? We don't know. We'll see whether or not it's able to spend There's something called the 3-day rule. Sometimes you want to use a 3-hour rule, 3-month rule. But in this situation here, I would use a 3-day rule, meaning can these shares close the next 3 days above this support level here in red? If so, then you might want to consider putting on a bull bet. I would look at selling premium deep out of the money puts, maybe with an insurance policy underneath, sell a put spread. The options should be very expensive, and they are. 78th percentile, very expensive, very attractive. I think the better bet, if you're looking to sell premium here, is to go with the KRE, because the KRE is diversified, yet the options are very expensive as well. Not as expensive as Western Alliance. However, you got diversification where you don't have diversification in Western Alliance. So I would rather take in less premium for the risk, the reduction in risk, than Western Alliance. And if you have a question on that, drop it in the chat box. TAJ, how's it going? Long time, brother. How you been? Been a while. Jody, AMD, of course, of course. Earnings in the rearview mirror on AMD. IEP got hit by a short pillar. Oh, that's Icon. Yeah, Randy, I know it was PACW, but there was an announcement out of Western Alliance as well, or there was a rumor about Western Alliance, but I think they came out and they dispelled it. And I don't want to float bad information here. So if somebody has more information about the statement from Western Alliance, we could highlight it here, because I don't want to be that guy out there that's spreading bad information. Thank you, Randy. Okay, MCRB. I don't know this company. I love the monthly chart. I'm taking it this is a biotech. I'm liking the consolidation here at this support level. We bounced off of it yet again. What I'd be looking for is a breakout. We're not there yet, but I'm loving these stochastics. You're getting a higher low on monthly stochastics. This is setting up for a breakout. Weekly view, nice reversal bar last week off the lows, off of that monthly support level. So buyers stepped in, and they stepped in on volume. So that's a vote of confidence for the shares. And I don't know if there was an announcement of some sort last week that caused that, but certainly the bulls were in control last week. Very strong back half of the week. I think that these shares will probably retest 575. And I would be a buyer on that retest. I would just check to see if they reported earnings. Okay, so MCRB looking good here from a macro view, not as a swing trade view, but a macro view. I think that longer term, this is going to start moving. Charts looking really good, weekly, monthly, and daily time frame. What else do we have here? IEP, it's Icon. If I could type the symbol correctly, that would be great. He happens to be one of my heroes. And I never vote against Carl Icahn. So, that being said, it's a pretty bearish chart. It's pretty bearish. Big volume to the downside on the month so far. Weekly view. Annihilated. It's a bit oversold. We're trading down below the third standard deviation Bollinger Band on a weekly time frame. I think we may get a pop here soon, daily view. Oh, it looks like we had the pop on Friday, but I think we may have more upside on this. Is that a longer term hold? I don't think so. The charts aren't implying longer term hold. It's implying that we may get more of a short covering rally here and then quite possibly roll over to new lower lows. I don't know what Hindenburg had to say, but the chart is speaking volumes that there may be another leg down here. But first, we'll probably get a continuation move up higher and we'll stall out and probably roll back over. AMZN. Good day on Friday. Weekly view. Looking good here. Amazon's been simply consolidating. It's in an uptrend channel. I think this is breaking out. Volume was good last week. Bullish reversal bar. Respected the rising moving averages. All the moving averages are going in the right direction. Daily view. Nice bullish reversal bar. Closed above his support level. Volume was a little bit iffy. That I don't like. But net, I think that odds favor bulls here on Amazon. QNST. This is getting punished. This is a void like the plague stock. At current on a monthly time frame, we've broken 2 monthly support levels. Weekly view. It's in a free fall. Broke daily support. What's RSI? You're going to get a dead cat bounce here in the next couple of weeks. What was the daily RSI? Daily RSI is at a 9 handle. Oh, this is the one that you had mentioned earlier. Oh, 810. I thought you meant $810. No, $8.10. Yeah, this can go lower, even with RSI down below 10. This is the reason why I asked you what the price of the stock was, because you can have a stock that trades down below $5 per share. You could easily see RSI down in the single digits. So just because we have RSI sub 10 doesn't mean it can't go lower. And I believe that, in fact, it probably is going to go lower. So what I would do here is go back to the monthly chart. What matters mostly is where you have historical support. If you're going to buy this nightmare sell-off, because you're fighting a battle right now of you. Like you're thinking. I've been in this spot where you see a stock that's got RSI. You're thinking it can't go any lower. RSI so oversold, but it can. It can go lower. And what you need to do is take a step back and think very, very logically and say, okay, where logically might there be buyers of like mind that could join me in supporting this stock? So what you're looking for is historical support. That is critical. And where you would have historical support, here's a support level here at $7.88. We're not that far away from it. If that fails, you're looking at $6.78. Those are the two price targets that I'd be looking for. Don't pay too much attention to the RSI. RSI is just telling you right now you have an opportunity. The historical support levels and the volume of the selling dropping off, that's going to tell you where you have probability of a good entry point and that support level holding. So pay attention to your support levels. I'll copy this for you, save it, refer back to it, but I would not enter the stock where we closed on Friday. I think that it's going lower. Next chart up, Cocoa. You're welcome, Pete. Not much data. I mean, it's in Fuego stock. The Vita Cocoa Company. I never heard of it. Good chart. Volume was great last week. Good breakout. Stokes are very extended, but they're just validating that the stock is in an uptrend. That's all. Daily view. Got extended, consolidated some gains. I don't know. It looks pretty darn good to me. I think this is a buy. I think it's a buy. I think it's going up higher. Watch for a bit of stalling at this upper band of resistance. I'm not sure when it's going to get there. This is rising, so I can't give you a number right now, but I think it does go higher. The one thing I will put out there is this, is that your daily Stokes, you saw more selling on Friday than you did on Thursday. This may have more of a pullback to go. Watch for this volume bar to drop down a bit. Watch for it to hit a support level or watch for it to hit a rising moving average or a support level and try to buy off of it on declining down volume. Otherwise, I think it goes up. Tesla. Tesla wants to go up, I think. We had a reversal bar the week of the 24th. It held support. We had a move up higher last week. Volume a bit light. We closed right at the 20-period moving average. Daily view. Now, I wouldn't buy it here. You're buying right into all this resistance. If it pulls back, and Tesla's got problems, you're going to get pullbacks here. Here's a 2-hour chart. You can see they stopped it right dead at 179.07 where we have resistance. So you want to buy a pullback. If we pull back to, say, 168 around there, that would be interesting. Let's close it out with CrowdStrike. We're way over tonight. CrowdStrike. Okay, so CrowdStrike last week, bullish reversal bar off of historical support. So that's bullish. Stochastics are going in the wrong direction and light volume last week. So I'm not getting the warm and fuzzies that we're going to have a strong continuation move up higher. We may. Good price action on Friday. Volume a bit light. Stokes are hooking up higher here. I think you're going to get some backing and filling in this wedge formation. I don't see a really urgent need to get long of these shares. If you could buy the pullback as close to the support level at 119.40 as possible, I think that you're going to be all the better for it, because if it breaks 19.40 and closes there, you're going to want to stop out. So one way to play it, sell some puts immediately below, generate some cash flow. If you get the shares put to you, okay, you got a discount rather than buying where we closed on Friday. So that would be the trade here. I think we're going to have a little bit more consolidation. It could be wrong, could be headed straight up. But that's the way I would play this right now, because those weekly Stokes are rolling over. That concerns me. We're losing macro momentum, and that's a bit of a concern. Sean, thank you. Franklin, thank you. And everybody have a awesome and profitable week. Oh, I didn't go over AMD. AMD. Jody, I didn't forget you. We got to go over AMD. Thank you, Randy. Appreciate it. Thank you very much. Looking forward to it. Microsoft said AMD is not involved in Really? I thought that was a headline too. That was fake news, huh? Interesting. Thank you for that. AMD. AMD's a buy. It recaptured support. If we closed back down below, where is the... If we closed back down below $89 a share, I think you need to get out. But I think that this is a buy, because I like the daily chart quite a bit here. If you can get a pullback to... Let's get rid of this for a moment. If you can get a pullback down to 87.33, which is daily support, I think that would be a great entry point, because you could put your stop right below it. It doesn't have to be exact. AMD daily retest port. That would be my trade on AMD. TZ Burton, thank you very much. Jody. See, Jody got value out of that. Thank you, Paul. Because he said AMD not working on Athena doesn't mean Microsoft isn't. Well, you want to have validation. You know, they could be working with any number of semiconductor companies. So we want to be factual. We're not saying they're not, but we want to only deal with fact, not hopium. Blues. Good night, folks. Everybody have a profitable trading week. Thank you for being here. Like, subscribe. You know the deal. Take care now, and I'll talk to you in a couple of weeks. Be well.